Last year, investors pulled over $500 billion out of mutual funds and poured $1.5 trillion into ETFs. That's the biggest shift in investing history. Something is happening, and if you don't understand the difference between these two, you might be paying more, earning less, or missing out entirely. Today we're settling it. ETFs versus mutual funds, what actually matters, and which one makes sense for you. Welcome to Fiscal Fluency, the language of wealth. And if you've been following along, you've heard us talk about index funds and dollar cost averaging. Both of those strategies can be done through ETFs or mutual funds, but they're not the same thing. By the end of this video, you'll know exactly how each one works, where your money goes, and which type fits your situation best. Let's start with what they have in common. Both ETFs and mutual funds are baskets of investments. Instead of buying one stock, you buy a share of a fund that holds dozens or hundreds of stocks, bonds, or other assets. Instant diversification. The difference is in how they're built and how you buy them. A mutual fund is priced once per day after the market closes at 4 p.m. Eastern. Everyone who buys or sells that day gets the same price. An ETF, exchange traded fund, trades on the stock exchange just like a regular stock. The price moves throughout the day, and you can buy or sell anytime the market is open. Now let's talk about what most people actually care about: cost. The average actively managed mutual fund charges around 0.59% per year. The average index ETF charges around 0.05%. That's more than 10 times cheaper. Here's why that matters. On a $100,000 portfolio, a 0.59% fee costs you $590 a year. A 0.05% fee costs you $50. Over 30 years of compounding, that difference can eat tens of thousands of dollars from your returns. And there's a hidden cost too. In 2025, 52% of mutual funds distributed capital gains to shareholders, meaning investors owed taxes even if they didn't sell a single share. Only 7% of ETFs did the same. ETFs are structurally more tax efficient because shares trade between investors on the exchange. The fund manager doesn't have to sell holdings to meet redemptions. Here's the stat that changed investing forever. Over the last 10 years, 86% of actively managed large cap mutual funds underperformed the S&P 500. 86%. The professionals with teams of analysts and Bloomberg terminals couldn't beat an index that you can buy for 5 basis points. That doesn't mean all mutual funds are bad. In less efficient markets like emerging economies or certain bond categories, active managers do sometimes add value. But for the core of most people's portfolios, US stocks, total market, S&P 500, index funds win, and they win consistently. So should you just sell all your mutual funds? Not necessarily. Mutual funds still have real advantages. First, automatic investing. Most mutual funds let you set up automatic contributions. $50 every paycheck, straight into the fund. Some ETFs offer this through certain brokerages now, but it's still smoother with mutual funds. Second, fractional simplicity. With a mutual fund, your entire dollar amount gets invested. If you invest $100, all $100 go to work. And with ETFs, you traditionally had to buy whole shares, though most major brokerages now offer fractional ETF shares. Third, your 401k. Most employer retirement plans only offer mutual funds. If your company matches contributions, that free money matters way more than the ETF versus mutual fund debate. Always take the match first. Here's the framework that cuts through all the noise. If you're investing in a 401k with an employer match, use whatever funds your plan offers. The match is free money, don't leave it behind. If you're investing in an IRA or taxable brokerage account, low-cost index ETFs are hard to beat. Lowest fees, most tax efficient, maximum flexibility. If you value set it and forget it, automatic investing, and your brokerage doesn't support fractional ETF purchases, index mutual funds are perfectly fine. Vanguard's Total Market Index Fund and its ETF equivalent hold the exact same stocks. The worst choice isn't ETF or mutual fund. It's not investing at all. This is education, not financial advice. I'm not a financial advisor. Every situation is different, so do your own research or talk to a professional before making any moves. Now you speak both languages. Next time, we're tackling something everyone talks about, but few people understand: how to actually build passive income streams that work. Stay fluent.